So this is a topic that kind of comes up a lot when I have these investor calls. We get into a situation too often where once people start investing in real estate, they kind of forget all the benefits of how they got started, how they got into traditional assets like stocks and bonds, and then they move on to the real estate side. Or you get into a situation where either because people have well-intentioned financial advisors or because they feel like the alternative assets are all Ponzi schemes, they never ever venture out to the alternative side. So my goal is to kind of bridge that gap and kind of show how the pros and cons actually complement each other really well. So this is a presentation I did actually for the Learn and Grow event, which is a picture of this in the background. This is the Renault winery, and it's a perfect example of a alternative asset that you were able to invest in 4 or 5 years ago. So it was always nice to go back there and actually see how they actually transformed the property using investor money. And I think it always serves as a great example of what private equity can do and how attainable private equity is to someone who has built up somewhat of a large portfolio, but is not worth 10, 20, 30, $40 million. So let's get started. So first off, just the usual disclaimer, all investments have risk. We're not saying that these are the perfect strategies. These are just the strategies that we personally use. And before making any financial decisions, make sure you consult with your legal team, including your tax attorney, your accountant, your attorney, and any other professionals that you have in your circle. So the importance of the right question. So a huge eureka moment occurred to me when I stopped looking for the perfect strategy. Instead, I was looking at my portfolio as it stood and asked myself, is it too risky? Does it need to be more diversified? Does it provide enough appreciation? Is it too complicated? Does it provide enough cash flow? So these are all questions that were coming about in 20, 30 years of me investing in traditional investments and then making the transformation to the alternative side about 10 years ago. And what I realized was I was winging it from investment to investment. I was never looking back at it and actually having like a clear-cut strategy. I thought I was. For example, when I got into stock picking, I started looking at like dividend strategies and high yield strategies and everything. And I thought that was me diversifying and doing the right things. However, because I wasn't asking the right questions, I realized that I was kind of winging my investments and going by what popular suggestions were instead of actually what was right for me in my own portfolio. So we're going to debunk the asset allocation myth. So the first thing we're going to do is just talk about some of the pros of traditional investments. Then we're going to get into some of the pros of alternative investments. And then we're going to go into how they actually complement each other surprisingly really well. So traditional investments. So this is my background as a traditional investor. These days, I've evolved into just a simple traditional investor with a focus on low-cost index funds. That is 20 years of different strategies that never really outperformed a traditional index fund. So this strategy is kind of like the basic strategy, but this is also my strategy after a series of trial and errors that kind of led me here. So some of my highlights, I started investing when I was 14 years old. My oldest brother gave me a copy of Rich Dad Poor Dad, bought my first mutual fund. That didn't go too well. Then I was like, okay, how do I do this how do I follow the so-called experts of the space? Started reading about Warren Buffett, Peter Lynch, those names, started stock picking, went to college, thought that's what my career was going to be. And sure enough, I go into college during the Great Recession. And then I have to pivot. I get recruited by the government. And then I go on to get my MBA and kind of went a whole different route. But my background is I did start investing in stocks for the 14 years, and I still do today. So I failed almost every known strategy. Now, I realized that my portfolio early on was appreciating really well. What was having trouble with was actually getting in cash flow from that portfolio. So that's when I kind of got into these stock picking strategies like the MLPs, the REITs, the utility companies, the blue chip stocks. And after every single, the same thing kind of kept happening over and over again. And what happened was I would underperform the regular index fund that I have in my portfolio. And whenever there was a downturn and there was supposed to be a defensive component to these high yielding stocks, the way that the algorithms work today, they just took everything down in kind. So you never really got that defensive benefits, so to say, of those defensive picking strategies. So again, I failed almost all the strategies, kind of sold into the fact that stocks were really great at appreciation. They weren't that great at cash flow. And then I published the Alternative Investment Almanac. That book is meant to be a bridge. It's not meant to be that alternative assets are better than traditional investments. It was supposed to be a bridge on how to use alternative assets to complement traditional investments and how kind of came up with these strategies. So the track record, why invest in stocks? So this is something that is overlooked commonly. And the truth is, stocks have an incredible track record. If you just look at S&P 500 index fund, since 1957, they had an average annualized return of 10.5%. Now that is saying that is to 2021. That's actually when I made the presentation. So there is a downturn in 2022, but at the same time, the track record is pretty impressive. It's almost 60, 70 years of 10% annualized returns. Now the big nuance here is that someone did not sell during the downturn, because that 10.5% could be completely eroded really quickly due to one or two bad time sales. So that is definitely a pro for traditional assets like stocks. Now, accessibility and liquidity. When I got started, I remember you have to go to your brokerage and kind of make the trades and stuff. These days, you have an app. You can get on, make a trade within seconds, and have your money, move it in and out. And that's definitely a positive for a part of your portfolio. And the key here is that liquidity is a positive for a part of your portfolio. And we'll get into the negative part about it as well. Then it's low cost. If you're just starting out and you're 18 years old, 19 years old, and you got a first-time job, you could put $1,000 into an index fund versus the alternative investments. Usually the minimum investment is $50,000 or more. Time commitment. So this is if you don't do individual stock picking and follow the market, you could literally just buy the index fund, set it, forget it. In 20, 30, 40, 50 years, it's probably going to be worth a lot more than it is today. And you do not have to waste any part of your time following those stocks. Now, if you do individual stock picking, that's a little bit of a different story. But my goal is to basically talk about the pros of the strategy that I use, which is just the index fund. Next one is the one that I feel like that is most overlooked. So collateralization. So a lot of real estate investors love the infinity banking concept, and they use these life insurance policies because they're middleman. The way that I work with my brokerage account, it's exactly the same way. So what they do is they collateralize my index fund and they give you a line of credit for it. Now it's a line of credit, not margin. So it is a little bit of difference, and usually have a pretty safe margin because they only give you 50% of what you have. So unless the market really goes down 50, 60, 70%, you don't get into margin calls. So it's really important that you could actually invest in stocks, collateralize the stocks, and then use that money to actually go invest in real estate and alternative assets, which is one of my favorite strategies. Next is social norms. This is just the simplicity of the fact that if you go to a barbecue, most likely they're not going to be talking about the latest apartment building investment, but they may be talking about Tesla and Bitcoin and stuff like that. So in terms of social norms, it's easier to have a conversation with someone if you invest in stock versus if you do alternative investments. So where I kind of had a lot of my trial and errors, that they centered around these three repeating scenarios. The first one is that higher yielding instruments like MLPs and REITs are no longer protected in downturns due to market algorithms that take down the entire market. Basically, when the market goes down, the whole market goes down. It's no longer just, oh, this part of the market is going down. But the way that it works is because of these ETFs and these index funds and everything like that, it's kind of like a zero-sum game. If it's going down, everything is going down. The second repeating scenario is a blue chip stocks dividend comes into question by a well-regarded analyst. What follows is a vicious cat and mouse game that only hurts the shareholder. DE is a great example of this. Their stock price was around the 20s and 30s. They had a pretty healthy 4 or 5% dividend yield. And then what ended up happening is a prominent analyst came in, they questioned the cash flow. Management denied it. It went back and forth. Long story short, the cash flow was a real issue. There was a management change, and GE, as you can see here, GE went through a vicious cycle, and then they ended up basically cutting their dividends down to basically 1 penny. And at that point, almost getting rid of it. And the stock investor was basically trapped in the stock once those allegations were made, because the dips were so severe that they would have had to take a real haircut just to get out of the deal. So that was an example, and this kind of example happens all the time because you have so many analysts covering these stocks, and just generally that the cash flow statements weren't as healthy as they made it out to be. Lastly, a well-regarded dividend stock begins overpaying for assets that are in high growth markets. A great example of this is AT&T. One of the kings of telecom. They start buying Dish, they start buying HBO. What's ended up happening is that reliable yield kind of goes to the wayside. A funny little story on AT&T. I owned it for 3-4 years. Every year they paid out 8%. Every year the stock was down 8%. So after 4 years, I broke even for 4 years and never really saw that imaginary 8% yield. So basically, we are in a new era of investing in the stock market where prices fluctuate based on sweeps and algorithms. So how do you rely on a market like that for cash flow? And the truth is you can't. So what is the problem with traditional investments? Liquidity leads to volatility, and volatility destroys yield. That's kind of my thesis of half my book when I wrote it, is basically that one statement. Is basically you can never create reliable cash flow if there's liquidity there. So that same liquidity that is a pro, if you're 100%, if your portfolio is 100% in that liquidity, liquid asset, then you're going to be always in trouble when it comes to cash flow. And the chart on the right is actually a great example. This is VNQ. This is the REIT fund, Vanguard REIT fund. And you can see during COVID, it went down just as much as the regular market did. There was no defense whatsoever during that time period. So even a well-diversified portfolio of MLPs, REITs, utilities, and blue chip players can't escape this pattern. I tried. I failed on every single one of those. So traditional investments, the bottom line is they will never turn in predictable cash flow. So what is the solution to traditional investing? So the first thing is to treat traditional investments as part of a larger investment portfolio. Second, build around the weaknesses of the traditional investments with a focus on assets that will lower the volatility of a portfolio while increasing the cash flow of the portfolio. Lastly, potentially collateralize your traditional assets to diversify without giving up the long-term appreciation potential of the stock market. So basically, in summary, is realize what traditional investments are good at. They are a low-time way of getting appreciation. What they are not good at is they are not good at creating cash flow. So when you look at your portfolio, figure out which part of that pie is the traditional side, and then figure out how to complement around it. So the chart that I have over here is actually a Tiger 21 chart. They're a high income, they're a high net worth group out of New York City. And you could see it's not one color. You could see that they invest in stocks, they have 25%, but they also equally invested in real estate. And this is a great example of the reason why you should do both traditional and alternatives. So let's switch over to alternative investments. So this is me as an alternative investor. I built a cash flow portfolio, and you can see the focus right away is cash flow. Buying limited partnerships in apartment buildings, no funds, life insurance policies, tech startups, ATM funds, flex spaces, and hard money loans. Basically, almost anything alternative investments, you tried it. I mean, you name it, I tried it in the last decade or so. I founded my own company, SIH Capital Group, in 2020 during COVID. And I published the Alternative Investment Almanac, which is supposed to help traditional investors make that bridge over to the alternative side. So as equal as I am a traditional investor, I also have the same resume from the alternative investment side. So let's go over some of the pros of alternative investments. And guys, I know I'm going a little fast. I'll answer any questions you guys have at the end. So team alternative. So the first thing is the cash flow. When there are profits, investors are actually partners, so they usually receive a share of those profits in the form of cash distribution. So it is much more bankable cash flow than what you would see in the traditional side, because the underlying asset is not fluctuating in price, but it's still paying out a healthy dividend. Inflation hedge. If a physical asset is purchased in an inflationary environment using low-cost fixed debt, the fixed debt can serve as a powerful inflationary hedge and lower the cost of the asset over the time of the loan. Also, the inflationary cost can be passed on to the consumer of the asset. So this is a great example. On our last property in Pennsylvania, we bought a 50-unit apartment building with a 3.8% debt instrument for 10 years fixed. No floating rate, no nothing. So if the inflation, as it is 7-8%, if that stays sustained for 2, 3, 4 years, then the property itself would have gotten cheaper by the difference between what we're paying in interest and what the current inflation rate is. So that's super powerful. In addition to that, is we are allowed to raise that rent by usually the cost of living adjustment, which is based on the inflation. So again, we actually, our main costs are fixed, but the top line numbers can be easily changed because of inflation in our favor. Next is lower volatility. Most alternative investments are private securities. There is limited liquidity for the type of investment. You will not see dramatic short-term asset fluctuations, which help avoid panic selling. Because as much as people like to say in hindsight how they weathered the storm, when they see their entire portfolio going down, they are always tempted to sell and try to get back in at a lower price. So I think not having that option for a portion of your portfolio is actually a really good thing. So again, continuing with the advantages, next is tax advantages. When you invest in syndication, you get Schedule Ks at the end of the year. And with those Schedule Ks, they pass on depreciation. So usually you could receive 2, 3, 4 years of distributions and actually show negative Schedule Ks because of the large depreciation. So it makes those first couple of years of cash distribution very, very tax friendly. I want to be careful about how much I glorify tax advantages, because too many operators out there are talking about the tax advantages without talking about the depreciation recapture and a lot of other things that you have to plan around when you get into the alternative space. But for now, we'll just keep it strictly on the distributions, and the distributions are pretty tax friendly because of the depreciation that's usually passed through when you're an equity investor. Next is leverage. So using long-term fixed debt allows the investor to invest the minimum amount but receive 100% of the benefits of the scale of a larger asset affords. So in a situation like our apartment building, the last one we bought, we only put 30% down, but we still get the benefits of the entire property. So we even though we only put down $2 million, we're getting the benefits of the $6-7 million property that we purchased. Passive. Most investors are not required to participate in the ongoing affairs of the investment and remain passive throughout that investment. The only nuance here is that sometimes we do JVs and joint ventures, and in those situations, those investors have to be active. And so there is a little bit of activity, but for the most part, after you wire the funds, you're not involved into the day-to-day of the operations, and you have a team that is creating those distributions for you. So post-COVID-19 diversification, I think this is, I kind of attempted to take this slide out because of how much I think we've kind of hit this over the last couple of years on this topic. But I think the point is, in the first half of 2020, the S&P fell by nearly 30%. The NASDAQ by 25% and Dow by 34%. In the last few years, blue chip stocks like GE, General Motors, and Wells Fargo all slashed or suspended their dividends. So now more than ever, private placement, passive investments that provide a preferred income should be a part of a well-balanced investment diversification strategy. Again, a part of, not the entire thing. That's my personal strategy. So what are the problems now with alternative investments? Usually a lot of operators, they don't talk about the actual problems of the alternative world. So the first is there's an educational barrier of entry. And I kind of see this all the time. And the problem is a lot of operators out there are great marketers, and they highlight what the potential returns are. In reality, once a deal goes live, all those potential returns are almost out the window, and it becomes an operational gain. And it's important when you as an investor is looking at a deal to really judge the merits, the merits of what is the operational team in place, what is the track record, what were the variables that were used in the previous deals? Are they still in play now? So I get this all the time now because a lot of limited partners started in 2018, 2019. And what ended up happening is almost any deal they invested in at that point produced 25, 30% returns in 2021. Now, if they stayed 100% passive and didn't really focus on educating themselves, they would have no idea why they earned that 20, 30%. They would just say like, oh, I just invested with the right operator. In truth, the majority of the operators made those 20, 30% during that time period. And the main reason for that is because they bought in a very low interest rate environment. They sold it in a low interest rate environment. Rent growth was very, very aggressive. Now, those factors are very, very different today than it was 3-4 years ago. Today, there's a lot of recent trends that the rent growth has stopped and actually reversed. And the holds are no longer 2-3 years. So the debt that was put on place in those deals are that much more important. But these are all the things that you need to know instead of just saying, oh, that track record is great. They made 26%. They must really know what they're doing. I'm just going to keep writing checks to them. So that's the importance of actually educating yourself. Even if you're going to remain passive, you want to take the steps and kind of learn the key variables, create a network of other investors that you could piggyback ideas off of. So all of those things, when you're starting out, it's hard to realize, and you tend to not do it. And then if you don't take that first step, usually you won't go through with those alternative investments. So the second thing is time commitment to network. I always say this example: if you do this in the traditional side and you network with a bunch of CEOs, you're probably going to go to jail for insider trading. But when you network with a bunch of operators and a bunch of limited partners, your portfolio can really skyrocket in value because that networking time gets rewarded 5 to 10x whatever time you put into it. Next, the high minimum investment amount. A lot of people getting started to be an accredited investor, there's a certain threshold you have to reach. You're probably not reaching that from day one. So there's a kind of barrier of entry to actually getting into the space. Most investments are around $50,000. That could be a lot. That could be pretty daunting for someone who only has $5,000, $6,000, $7,000. So those are the things that stop people from getting into the alternative space. And then the last thing is actually locking in their money, because people that are used to the traditional side, they can't understand how they would make an investment and just leave it there for 7 to 10 years, and why that would actually be a positive in most cases. So what I like to summarize here is, besides the popular terms of, hey, be a passive investor, in reality, what I like to say is that when you get into alternative investments, you should be actively passive. That means, yes, after you wire the money, but before you wire the money, you need to do a lot of homework, you need to do a lot of due diligence, and you need to do a lot of networking. And then, yes, you're going to be completely passive after you make that wire. So what are the solutions to alternative investing? So treat alternative investments as part of a larger investment portfolio. Again, a part of, not the. Build around the weaknesses of alternative investments with the focus on assets that will add liquidity to your portfolio and increase your time flexibility, which we know that the traditional side does that for you. And then potentially collateralize your alternative assets to decrease the need for liquidity. So again, like if you get into life insurance policies or infinite banking concepts and you have that cash value there, that makes it less of a burden to lock in that investment for 10 years, because you have access to it if you need it. So this is an example portfolio. This is actually, I took out of my book. So on the left side, this is your traditional S&P 500 index fund. So if I spend 1% of my brain power on executing the trade, and every year kind of reevaluating where it's at, and then I could spend 99% of my time networking, working on building my education on alternative investments, learning about mobile home parks and networking with the mobile home parks and vacation rentals and self-storages. And I build out a well-diversified, cash flowing, low volatility portfolio. Combined, I have what I like to call the perfect portfolio. So let's debunk some of the myths. So cash flow plus appreciation. So a great portfolio will cash flow and appreciate, but not every asset can do both. Coming to that self-realization that my assets should accomplish specific roles allowed me to look at my portfolio subjectively and see which assets were out of place. So the problem is, for the first 10 years of my life in the stock market world, I was trying to get both cash flow and appreciation just from my stock portfolio. And that was the wrong thing to do. And I didn't realize that until I started getting into the alternative assets and starting to see, hey, the stuff that I was looking for in the stock world is easily accessible in the alternative space. And then vice versa, I didn't want to give up what I learned in the traditional side so easily. So I figured a way to kind of complement that. So let's look how the two actually do complement on a bigger scale, on a high level scale. So on the traditional side, I spend 1% of my time these days. I don't follow individual stocks, nothing like that. I focus on appreciation, not cash flow. I invest whenever I have some spare change, but not enough to do a private investment. And I know I'm pretty fully liquid, where if I need to, I'll either collateralize more or need to sell and buy private alternatives. So on the traditional side, it's super simple. It's extremely time-friendly strategy. When left alone to compound earnings, is brutally efficient at creating wealth. However, if I had all my money in the traditional investments, I would feel continuous pressure to sell due to the poor yield and market volatility. Now let's take a look at the alternative side. So 99% of my time here I spend on networking and researching. I focus on cash flow. I don't mind the high minimum investments, and I actually prefer the fact that it's completely liquid. So the alternative investments are more time consuming to develop, since you need multiple sources of cash flow, and each source may take years to become competent. Here, cash flow is king, and the time I save with one low-cost index fund allows me to spend the bulk of my time networking and researching the best alternative asset. So something new. So many investors make the mistake of switching strategies and allocating 100% of their portfolio into something new, when in reality, they just need to tweak or adjust what they're already doing. And thank you guys for checking this out. I'm going to stop sharing here. This is my website, SIHcapitalgroup.com. This is my email address, Denis at SIHcapitalgroup.com. Thank you guys so much for jumping on. I really appreciate it. We're going to have some great webinars coming up. I'm probably going to get our CPA for SIH Capital Group on, and then January, I might try to get someone who does retirement plans on. Thank you guys so much for joining. I really appreciate it. Thanks, guys.